The global economy weakened again in late 2012, but the outlook is now improving for OECD economies. In the first half of 2013, we see a return to moderate growth in the United States and an acceleration from low levels in Japan. In Europe, a meaningful recovery is likely to take somewhat longer. Within the euro area, there is a divergence between growth in Germany, which is likely to pick up strongly over the first 2 quarters of 2013, and that of other countries where it will remain slow or negative. Growth among emerging economies remains much stronger than that of advanced countries and will continue to drive global growth this year. Growth in China is expected to continue to well exceed 8%. In spite of buoyant financial markets, self-sustained growth is still not secured. Bold policy action to support activity remains necessary in all major OECD economies. Monetary stimulus remains a key instrument for supporting demand. However, it may bring excessive risk-taking in some areas. Credible medium-term fiscal plans are needed and should include the elimination of costly distortions in the tax system and seeking greater efficiency in public spending. While countries follow through with planned budgetary consolidation measures, they should avoid tightening policy further if growth disappoints. On the structural side, reducing restrictive product market regulations will help to unlock investment and reduce prices for consumers. Labour market reforms will help to create jobs and reduce the risk of long-term unemployment. The policy stance must be tailored to country-specific needs. Monetary policy stimulus has been most effective in the United States, with household consumption picking up and the housing sector beginning to rebound. However, the point where the cost of further quantitative easing outweigh the benefits is likely to be within sight, and in that light, the pace of bond purchases may have to be adjusted. Japan has so far used monetary easing to a lesser degree. The Bank of Japan's adoption of a 2% inflation target is welcome, but will require more aggressive quantitative easing and asset purchases. The prospect of more aggressive easing has already resulted in a 20% depreciation of the yen in real effective terms and a surge in equity prices. This has boosted the near-term growth outlook. The zero interest rate policy should be maintained until inflation is firmly positive and a readoption of forward guidance could be considered. In the euro area, while the risk of extreme events seems subdued, negative feedback loops between weak bank balance sheets and heavy government debt burdens are still impairing banks' ability to lend money, and aggregate euro area bank lending is still contracting. Policy rates are already very low, but some scope remains to reduce them further given weak demand and inflation well below the ECB's objective. The central bank should give more specific forward guidance as a way to easing current financial conditions. To strengthen the banking system, the European Stability Mechanism should be allowed to inject capital directly into banks if needed. This should go alongside rapid progress towards the construction of a fully fledged banking union. The Cyprus crisis, while a special case, shows the importance of addressing banking crisis directly and decisively.